Hey guys, how you doing? You know who it is. I'm back. I'm back. I wanted to talk to you today briefly before I got out of the office um, about a couple of things per the title. They're coming. They're coming. Who am I speaking of? Who are they? Are there? Who am I referencing? I'm talking to folks that are on the fence about buying a home and or repositioning themselves, pulling cash out of properties. When I say they, the they that I'm speaking of or speaking to is what we call loan level price adjustments, loan level price adjustments in the industry. And what a loan level price adjustment is, it's additional cost to do loans or borrow money. Let me put it that way. So I wanted to hop on spontaneously without any, pomp or circumstance, and talk about these loan level price adjustments that are going to be coming. So, again, um, if you're looking to buy a home, okay, and you fall within a certain cohort, certain group of people, first time home buyers that meet the following income test. Your income is at, okay, 100% of the area median income where you're living or where you're going to buy. That's first test. Second test is that you're at or beneath 80% of the area median income wherever you're looking to buy. Um, and then obviously, if you're below that, okay, the rules have been uh, changed in your favor. Okay. Uh, the powers that be want to see those of you that fall within those income brackets and or a first-time home buyer haven't owned real estate, primary residence, if you will, in the most recent 3 years. The guidelines have been updated to allow you an advantage, a competitive advantage. Okay. So that's a good thing, right? That's a good thing for you if, again, you are a first time home buyer. What does that mean? What that means is the cost of the monies that you're going to borrow have been uh, lowered significantly. Okay. So, again, if you're a first time home buyer, haven't owned real estate in the most recent 3 years, okay, and in some cases, that definition adds primary residence, right? But I'm going to say ownership in the most recent 3 years. You're at 100% of the area median income or 80% of the area median income. And obviously anything below that. Ton of things in your favor. And as you see on the screen here, this is a letter from Fannie Mae. There's two conventional channels, if you will, government sponsored entities, Fannie Mae, Freddie Mac. But as you can see in the highlighted area here, um, we'll go to the second part of the sentence. It says, it says last year, we, Fannie Mae, announced changes to our pricing for second homes, high balance loans, and cash out refinances. Okay. I'll deal with those people here in a minute. And introduced LLPA'S, loan level price adjustments, waivers for certain borrowers, and affordable mortgage products. They're doing that. They're implementing those changes to the framework, right? To increase, let me highlight that, to increase borrowers historically underserved by the housing finance market while ensuring a level playing field for small and large lenders. Okay. So that's what they're saying. So again, if you're in one of those cohorts, right? First time home buyer, 100% area median income for the area, 80% or below. Now's the time. Okay. This is akin to when rates were really, 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 really low. And I was trying to compel you to get in the game. And remember, at that time, the number one rebuttal that I had was prices are too high. We're waiting on prices to go down. If you don't know, let me explain something to you. When prices are low, interest rate, the cost of money is low, home prices are going to be higher simply because there's more people with money are motivated by the lower interest rates to take said money and put it into a real asset. Okay. Even if it's your primary residence. I know everybody on the internet is Warren Buffett, right? I know everybody wants to. I'm not talking to you guys, just talking to folks, those underserved folks that the article is talking about that missed the boat when money was real cheap. Okay. And folks were like, let me borrow it and put it into a real asset. Okay. Because the way inflation works, it's almost like I'm getting this money for free. And a lot of folks did that and then put renters, people that couldn't afford the home price at the time and or really didn't understand to get into the game. And now you're renting. Okay. So whenever there's a lot of money chasing few goods, the price is going to go up. Now, let me digress. So keep that in mind. Now, to curtail that, to slow that trend down or to stop it, the Federal Reserve has raised interest rates tremendously, more than they have over the last 20 years in a 6-month period, for the purpose of killing that demand, killing the ones that have the ability, the acumen, the credit, the income to be able to go out and get that lower cost of funds and put it into an asset such as residential real estate. And you may have not known that you didn't know what you didn't know, okay? Because you are fixated on the cost. Now you're fixated on the interest rate, still not understanding the opportunity that presents itself. So I'm trying to present this case to you in a way, in a manner that if I were you, I would be able to understand, because I'm not that smart, okay? That's just me. So now they have all of these loan level price adjustments that they've moved out of the way to bring your cost of funds down so that you could get into the market. Now, I just said, whenever money is cheap, home prices are going to go high. Why is that? Why is that the case? If somebody's watching and you want to interact, please interact. But the reason that's the case is because that old supply and demand thing, right? Supply and demand. So when there's not enough homes and everybody's got money, now we got 20, 50 people bidding on one home. The price is going to go up. Sellers they were licking their lips. It's changed because interest rates have gone up purposefully. It's not a magic thing. It's nothing for you to be afraid of. That's the only tool that Jerome Powell, which represents the other or the 12 Fed governors, that's the tool that they have to keep inflation in check. Their mandate is inflation needs to be at 2%. Don't know if we're going to get back there. We might have a new norm, but that's the econ class for today, right? Now, in the article, it mentions second homes, high balance loans, and cash out refinances. This is a warning to you guys. If you want a second home, if you want a jumbo loan, right? That's in excess of $726,000 now, I believe, right? My memory serves me correct. Or if you're wanting to tap into some of that equity, that groundbreaking equity that we've had over the last 2.5 years, you better do it now because you're about to be penalized, okay? So that the folks that missed the boat with the low money can get in the game. Simply put, I would if you're looking to tap into some of your monies, the things that you need to look at is this: what's the maximum loan to value? Because they're tightening up, they're going to lower that. A lot of you wholesalers, investors, whatever you want to call yourselves, they're going to start putting a time limit on how long you have to be on title. It's going to be a year. Okay. Even on conventional, right? There's no more loopholes there. What's the bird strategy, right? Where you rinse and repeat, you're going to have to hold that thing. Okay. So there's a window And I've been super busy. I went out to everybody in my database. You should have gotten emails, the newsletter, what I'm speaking of. And those that want to move forward, we're moving forward. Kudos to you. But if your second home, jumbo loan, are trying to tap into some of those equities, you better move now. If not saying you can't borrow money, but it's going to be more expensive. It has nothing to do with credit score or anything of that nature. It has to do with the powers that be want to let the little guy that couldn't get in when the rates were super, super low and they were basically priced out. Okay. So understand you probably have another 45 days, applicate and get that thing on the road and get the money while you can, while rates are coming down. Okay. And do so before these loan level price adjustments adjust. Okay. Hopefully that makes sense. Let's move on. Let me show you what you want to kind of watch. I'm back to the home buyers, first time home buyers. Okay. I lied. We're gonna look at some more numbers because you guys have to understand how this money works. And this is real 10,000 foot level, right? Learned this years ago when I first got into the business. But bottom line, inflation, okay, inflation and interest rates are really more tied, especially mortgage rates, not credit card rates and things of that nature. Those are really tied to what the Federal Reserve does. When they increase those interest rates, you really see it in the credit cards, the unsecured debt, the revolving line of credit. It's pretty much a one-to-one correlation. But as far as it pertains to mortgage interest rates, they're more tied to inflation. Again, I gave the example before. When money was real cheap, right? The cost of homes skyrocketed because you had a lot of people with money trying to buy houses and they were finite. There's not as many homes. And there's been a shortage for almost 20 years. Please quit listening to these people online. They don't know what they're talking about. But anyway, this is the US Treasury rate that you see on the screen. Okay, this is called a yield curve. Now, what's supposed to happen is this: the further out we go in time, 30 years, right? Those yields, the investors that buy those types of bonds, the idea is, hey, I get more money for tying my money up for a longer period of time. So the further out you go on the yield curve, the higher the return should be. So as you can see today, the yield, right, for the 30-year rate for the T notes, the 30-year T bills is 3.603%. But as I go back to the lower terms, 10 years, and that's 10 years is the benchmark, it's 3.451%, right? Not too much off of that. That's right. But as I keep going down the yield curve, hold up, 7 years is higher, a higher return than 10 years, right? 5 years is a higher return than those two, so on and so forth. So this is when or if you've heard of the term an inverted yield curve, that's what that means. It means, hey, why would I tie my money up longer when I'm getting a better return on the shorter end of the yield curve? Okay. Stay with me. I know it's boring, but this will help you understand the opportunity and stop looking at the purchase price, especially if you are buying a primary residence. And why is that the case? Because you're going to live in the house for more than a year, right? Probably going to be there more than 10 years. Okay. So that's what you have to understand. And if I'm going to be there long term, when the time or if the time comes, I can reposition myself as far as a refinance is concerned. But what's most important right now is that I secure the home because Robert told me and showed me with data, not hype, not influencers, right? But with data showing that every year home prices are increasing. Over the last 2 years, they've just increased it. They've increased at an astronomical rate. That's why the Federal Reserve is raising the Fed funds rate, the cost of money, to slow down the appreciation. But even with all of the slowing, we still have unprecedented increase in appreciation. especially in the home state of Texas, right? And we lend in all 50 states. There's only a couple of places in the United States that have a large decrease in appreciation, okay? And those are the ones that had the largest run-ups. But for most of us, real estate is local. You're good. You're at anywhere between 7 to 10% this year. So what does that mean? You got to buy now, because if you keep waiting, the home prices are going to continue to go up. You know this because the new conforming loan limits for conventional FHA, VA doesn't have any, but they keep going up. They're not coming down. They're going up. Okay. So yield curve. This is why you want to watch the 10-year, because this is the benchmark that we watch. Because as you start seeing the 10-year yield come down and the yield curve get back in the proper fashion, for lack of a better term, where the lower end of the yield curve, the 2, 3, 5-year coupons are not paying as much, okay, it goes up in progression. So again, the longer I tie my money up, the more money I should get back. So now the yield curve has been inverted. Let me leave that there. Now, let me go to something that makes a little more sense with this. Then I'm going to get out of here. So now what you're looking at here, okay, this is an index, composite index for 30-year fix. And here's the concept, right? The index is given a number. And let me go back here. When were rates low? So 2021, they started popping off probably about February. See how low those bad boys were? I know y'all like, man, I should have bought then. Woulda, coulda, shoulda. Don't worry about it. So 2.66, right? December 2020. Look at the composite index at the top, 813.7. So the concept is the lower the rate, right, the more people are going to borrow money. Lower the rate, more people borrow money. So as we can see this trend, as we've been going over the last couple of years, rates low, and you see these rates, 2.68, 3. Okay, they're starting to increase. Okay. And as they increase, the index, the composite index starts going down. Less people are buying. Makes sense, right? Because the rates are going up. And so we get to the peak, which is probably about 7.8%, right, on the 30-year. That was roughly the 24th of October, 2022, index down to 201. But now, as you can see, because inflation is starting to come down, and remember what I was telling you, inflation and interest rates with mortgages, they got an inverse relationship, right? So as inflation starts coming down, or when inflation is going up, the Fed raises the funds rate, okay? And then what happens is mortgage bonds, the interest rates go up because the yield curve is inverted. Well, when the Fed raises those interest rates up, inflation starts to come down. It peaks and starts to come down. So when inflation starts coming down, so it's not an inverse, it's almost tied. But when inflation comes down, now mortgage rates are going to start coming down because the yield curve is getting back to where it needs to be, and inflation is getting back in line, so that the shorter end bonds are going to start yielding the right type of return, and it will encourage investors to put money more on the longer end of the yield curve because it's going the right direction. Shorter term, here's a return, and as we go further out in time, I'm going to make more money down the line as an investor, right? And it makes sense. So that's how these rates are going. So now that you're watching inflation come down, what are the rates doing? The rates are coming down. Okay. Now I know that's the boring part, but that's how you need to look at this. And so a combination of policy, the government saying, hey, too many of the folks, everyday salt of the earth folks lost it, right? Those are people that are 100% of the area median income, 80% of the area median income. When these rates were in the 2% range, home prices were super high and they couldn't pull the trigger, or they didn't pull the trigger. We're going to fix that, right? We've been raising the cost of funds to kill inflation. All inflation is prices are higher. So they're bringing those prices down. And inflation is real. I mean, costs are up everywhere. But if you're someone that's just been waiting on the sideline because you think rates are going back to the 2%, you're going to miss another boat trying to help you out. Okay. So, what should we do, Robert? In my professional opinion, now's the time. January is the time for you to do a home consultation, right? Again, you don't have to worry about hard inquiries. If you're dealing with somebody that doesn't offer soft inquiries, I don't know where they are. It's 2023. We've been doing soft inquiries for 5 years. And with that soft inquiry on your credit, you can relax, but you can do a complete application. And this is what you have to do to find out where you really are. Okay. It's akin to you calling the doctor, I'm not feeling well, and you want them to diagnose you over the phone. I know there's a lot of telehealth, but they can't tell what your blood pressure, can't draw blood, can't really diagnose what's popping. You got to, the life is in the blood. Got to get the blood drawn. Got to do the application. So we have a solution for those that are worrying about inquiries, right? I did a video, put it up yesterday. I can already see the algorithm changing, getting prepared to become more conservative and look at trended data. You guys think you want trended data. I don't think a lot of you do. Okay. So now there's a sense of urgency, and this is for those that want to buy. No hype. If you want hype, go to YouTube, and you got plenty of folks telling you the sky's falling every day. That's because they get paid from your attention. But if you want to buy, apply. Don't have to worry about your credit inquiries because you have a soft inquiry, and submit all of your documentation just as if you were going to buy today. Now you can get a plan of action from a real in the field if you're dealing with me, right? And then you can work from that premise. You don't have to guess and guesstimate and go to the credit repair person and jam you up and woo, woo, woo. No disrespect. I'm sure they got about 5 real credit repair people out there, right? But the masses, they trap it. I'm not lying. So anyway, these are things that you need to understand. So just to recap, if you're a first-time home buyer, depending where you fall in the area median income in your neighborhood, now's the time. And you want to do so before springtime because there's a lot of bent up demand. Because the sweet spot, anytime we get under 6%, oh, they're coming off the bench. They're coming off the bench. I'm already seeing it. Okay. We busy. All praises to the Most High. They're coming off the bench though. And there's still not enough homes. Matter of fact, there's probably less homes now because the builders, they switch gears. They're going where the money resides. So you're going to be competing against a lot of people. If you can move now win. But if you could get in your home before March, you win it because it's just less competition. It's just a numbers thing. And the rates are coming down to where you can strike. So that's that cohort. Now, if you own a home and you're looking to tap into some of the equity, they've changed the rules for those that missed it, and they're going to penalize those who got it, right? So if you want to pull that money out, you better pull it out before March. If you want to buy a second home, I would advise you to do so before March. If you want to buy jumbo, I would advise you to do so before March. Not saying that you can't get it after March, but it's going to be more expensive because what the government giveth, it also taketh away from somewhere else. We the people. So it's promoting first-time home buyers, but it's going to tax you because you got it. Okay. It ain't tricking if you got it and they say you got it. So all joking aside, impromptu, do what you will. You feel me? Now, if we can help you out, reach out. Let me throw it up here. It's also in the comment section. But a home loan consultation, baby, don't cost nothing to talk. And we don't want to just bump our gums. We want to take action because it's about that action, right? 2020, 2021, everybody was like, you got all the talking and commentating you need to get. It's about that action going forward. You either is or you ain't. And if you ain't, trust me, there's a whole lot of isn't going on. So get in where you fit in. And if not, that's cool too. There's the link. Schedule a consultation. Get ready to apply. Got the soft credit inquiries. We can handle it all. I'll be here all day trying to tell you what we could do. We're seasoned. We do all loan types, even non-qualified, non-QM loans. You don't hear me talking about it a lot because a lot of y'all don't qualify for it, just straight up. But we could do those. So let's consult. Let's see where you are. Let's see where you're wanting to go. And then let's see if we can work with one another. Let's see. With that, I don't see any questions. I thank you for your time, but mine's is up. As I always say, guys, let's be good to one another. Let grace abound. And until the next time, like Prime said, he said, we coming. I'm telling you, they coming. These loan level price adjustments, they coming. Y'all better get in. Peace.